One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of investment banking. My name is Alex Mason, and I am your host. And you already know what it is. I'm just chilling here, recording live from Ithaca, New York, just enjoying this beautiful transition of the season. I'm recording this in October 2023. The leaves are changing over here. It's breathtakingly beautiful. I see the hills and the forests. The leaves are falling off of the trees and changing from green to yellow to red to brown. And man, nature is just so beautiful sometimes. So that's what I'm enjoying as of late when I'm not studying or talking about investment banking or business school. But I hope you're having a great day wherever you are in the world and whatever you're doing. And today, my friend, we're going to wrap up our little section on valuation. We're going to finish this thing up and kind of tie a bow on it with an advanced valuation concept. Today, I want to talk to you about something that's industry specific. Last episode, we kind of dove into the oil and gas world a little bit and talked about some metrics and things that are useful there. But now we're going to talk about a different industry and one that may be relatable to you depending on your background. But today's question is, how do you value a real estate investment trust? How do you value a real estate investment trust? And the real estate investment trust also goes by REIT for short, REIT. So I'll be referring to this also as REITs. Now, what is a real estate investment trust? Well, a real estate investment trust is a special type of company, a special type of entity that was created primarily for the purpose of owning real estate. And there are other types of REITs that actually don't own real estate, but that's kind of beyond this discussion. But that's essentially what they do. So they're based primarily in terms of their value on the cash flows that they're able to generate. Just as if you were a landlord and you bought a single family house and you rented it out, the value of that property would primarily be based on the cash that you were able to generate from that property. So a major difference with REITs that we want to talk about relative to other types of companies is that they don't necessarily use earnings, so to speak, or profits. REITs use a term called funds from operations, or FFO. FFO. So what is this FFO? Well, we can define FFO as this. FFO is essentially our profit or our net income plus depreciation, plus amortization, plus the losses from sales of assets, minus the gains from sales of assets, minus interest income. And I'll go ahead and repeat that. Funds from operations is equal to earnings plus depreciation, plus amortization, plus the losses from sales of assets, minus the gain from sales of assets, minus interest income. And the thing that's interesting about this is this immediately makes me think of the operating section of the cash flow statement, right? Because what does the operating section of the cash flow statement do when we're looking at a typical company? Well, we're taking our net income and we're adjusting it for gains, for losses, for non-cash expenses. That's exactly what we're doing here when we're looking at real estate with this FFO term. And it's this amazing light bulb moment that I just had now. I didn't even think about it when I was preparing for this episode, but that's what's happening. And it's pretty cool because we're getting a clearer picture of the true cash generating power of a real estate portfolio. We're not counting on the depreciation or amortization. We're adding that back in because remember that's accounted for in the earnings number. We're stripping out the effects of gains and losses because that's not reflecting the normal operating power of the business. And we're also stripping out interest income because that's financially related and doesn't really have anything to do with the power of actually collecting rents on properties. So what does this FFO concept mean? It means that we're measuring the general cash flow that the REIT is making, stripping out the effects of accounting, essentially. That's what we're doing. And also one-time expenses, one-time sources of income. Okay, so that's FFO. Now we can kind of extend this idea a little bit further to a metric that's grown more popular in the real estate world called adjusted funds from operations, or AFFO. What is AFFO? AFFO takes FFO and then subtracts out other forms of capitalized expenses. So imagine that you and I own a huge real estate project and we're thinking of doing some big painting project or a remodeling project that might reoccur on a consistent basis. Well, AFFO is preferred by some investors because it more accurately paints a picture of how much money can be distributed to shareholders. So if you and I are working on this remodeling project and we plan on doing this kind of a thing every couple of years, technically that expense isn't taken out of FFO. But for AFFO, we would take that out because it's an expense that is improving upon our properties and is kind of like part of our normal course of business, really. So if that kind of expense is part of our normal course of business, how much money could we theoretically actually pay to our shareholders? Well, money that is left over after paying those expenses, right? So that's what AFFO is doing, is it's stripping out the effects of those capitalized type of expenses. And the reason this is important specifically for REITs is that there's this interesting thing in the legal structure of a REIT. So by law in the United States, companies that are organized as REITs must pay out 90% of their ordinary income as dividends each year to shareholders. They have to pay it out. It's by law. These vehicles were effectively created to be income generating investment vehicles via real estate. And so the amount of dividends that a REIT can pay out is super important. And so that's why this AFFO number, by extension, is important because it tells you how much earnings power the real estate investment trust actually has. Okay, so that's FFO and AFFO. Now, there's some other things we can think about here, such as REIT valuation. We could look at our net operating income, which is just gross income minus operating expenses. It's kind of like your gross profit, so to speak. And then there's also another term that you might want to know called capitalization rate. Well, capitalization rate is just your NOI, your net operating income, divided by the value of the property. So if your property, let's say it makes $100,000 a year in net operating income, and let's say its capitalization rate, or its market value rather, is $1 million. Let's say it's worth $1 million. Then the cap rate is 100,000 divided by 1 million, which gives you 0.1 or 10%. That's your cap rate. Your cap rate is essentially the gross rate of return from the property. So that's another thing you could look at. Another thing with REITs that you could look at in terms of valuation is this concept of replacement cost or replacement valuation. And we actually cover this way back in episode 44 of the show, which feels like a lifetime ago. We talked about this replacement cost concept. If the asset or portfolio of assets was magically destroyed in an instant, what would it cost you to buy the land and build up equivalent properties from scratch? That is the replacement cost. And it's another way to think about valuation here, specifically in a real estate context. So with all those things said, real estate is a whole different asset class than other types of businesses. And there's a myriad of things that you can learn in this area but I think this should suffice as an introduction to the topic. So you have these different concepts: NOI, capitalization rates, FFO, AFFO. These are all important things to look at if you're considering valuing a REIT. All right, that's what I got for you today here on Investment Banking Insights. Thank you so much for joining me day in and day out and sharing the show with friends, anyone you think it could add value to. I truly appreciate that. And I'll see you next time. Have a great day.